Imagine October 2008. The global economy is in crisis. People are losing their savings. Banks have gone bankrupt. And then a document appears on one of the forums. Its author, a certain Satoshi Nakamoto, offers the world a new idea. Money that is not dependent on banks, governments, or even crises. Thus begins the story of Bitcoin. My name is Andre, and today we will dive into the matrix of digital money. But who is this Satoshi Nakamoto? Who invented the revolutionary currency? One of the most interesting theories is that behind this pseudonym is Paul Le Roux, a brilliant programmer and at the same time a criminal genius. Paul Le Roux started as an ordinary programmer who created an encryption system to protect data, but soon he used his knowledge for dark purposes. He organized one of the largest international networks for drug, arms, and even human trafficking, creating a real criminal internet empire. There is a theory that Bitcoin could have become his way of safely moving money around the world. Le Roux was arrested in 2012, and this coincides with the time when Satoshi Nakamoto disappeared from the horizon. Coincidence or not, there is no definitive answer yet. But the mystery remains one of the most discussed enigmas of the crypto world. But let's return to crypto. So, you want to transfer money to a friend through your bank. What happens? Your bank checks if you have money in your account, confirms the transfer, charges a fee, and only then the money is sent to your friend's account. All of this can take from a few minutes to several days. Now imagine that you can transfer money directly, without banks, without intermediaries and fees, and the transfer itself is verified by thousands of independent participants around the world. This is blockchain. Why is blockchain a chain? Blockchain is like a big digital ledger where all transactions are recorded. Each new transfer is a new block in the chain. And the most important thing is that no one can forge or change these records. Why? Because they are stored simultaneously on thousands of computers around the world. In a bank, everything depends on one center, the bank itself. If something goes wrong or the bank decides to freeze your funds, there is little you can do. Blockchain is different. It is decentralized. This means that no one can control or shut it down. Bitcoin was the first, but not the last. A few years after it, Ethereum emerged. It is not just money, but a whole platform for creating programs and applications. Imagine that Bitcoin is a calculator that can only add numbers, while Ethereum is a smartphone with many applications, from games to social networks. One of the main features of Ethereum is smart contracts. Imagine that you need to make a deal. You are buying a house, and all the terms of the agreement are written in the contract. But what if the contract could fulfill all the terms automatically without the involvement of lawyers, notaries, and other bureaucrats? Smart contracts are programs that operate exactly according to specified conditions, and no one can change or cancel them. Based on smart contracts, many applications have emerged in Ethereum. For example, decentralized financial platforms where people can exchange cryptocurrencies without banks, or games where characters and items exist on the blockchain and belong only to you, and not to the developers. Now let's talk about tokens. You are at a festival for which you bought a ticket. This ticket is your pass to all the events of the festival, and you can participate in any activities. Similarly, a token is a digital pass to certain projects or platforms on the blockchain. Tokens come in different forms. Some give you voting rights in the management of a project, as if you owned a part of the company. Others are used as virtual currency within a game or platform. For example, Uniswap tokens allow you to vote on changes to the platform, and tokens in games provide access to new levels and characters. An interesting point. Like stocks on the exchange, tokens can increase in value. If a project becomes popular, meaning if you invested in the platform at early stages, your tokens can increase in value by tens or even hundreds of times, sometimes even thousands. And now, for the most fun part, meme coins. They started as a joke, but over time they turned into real financial assets. The most famous of them is Dogecoin. Imagine a cryptocurrency that was created by two programmers just for fun. They took a meme with a Shiba Inu dog and turned it into money. In fact, they did not develop a new cryptocurrency. They took the source code of Bitcoin and simply modified it for themselves, launching it on a new network. Dogecoin was just a joke until Elon Musk started talking about it. He started tweeting that Dogecoin is the future, and the price skyrocketed. In just a few months, people who bought this cryptocurrency for a couple of dollars became millionaires. After the success of Dogecoin, dozens of other meme coins appeared, such as Shiba Inu. People started buying them in hopes of repeating Dogecoin's success. Not all of them succeeded, but some managed to earn quite a lot. It is important to remember that investing in such coins is somewhat like playing the lottery. Sometimes you can win, but most of the time you will lose. That's all. Cryptocurrency prices can skyrocket or suddenly collapse. But what does this depend on? Let's break it down with a simple example. Vegetable market. Let's say you have a market where tomatoes are sold. If there are many tomatoes and few buyers, the price falls. If there are many buyers and not enough tomatoes, the price jumps. This is how the law of supply and demand works. And the situation is similar with cryptocurrencies. The more people want to buy cryptocurrency, the higher its price. The more people sell, the lower it goes. But this is only part of the story. The fact is that the price of cryptocurrency is formed not only by supply and demand. News, expectations, and emotions play a huge role. Remember how Elon Musk's tweets sent the price of Dogecoin to the moon? In the crypto world, people's sentiments play a huge role. Good news can raise the price, while bad news can crash it. For example, when large companies announce their support for cryptocurrency, the price immediately soars, because people start to believe in its future. But news is not the only important factor. Imagine that Bitcoin or another cryptocurrency is limited in quantity, like gold. The fewer Bitcoins there are, the more they are valued. Bitcoin, for example, is programmed so that there will be no more than 21 million. It's like if there were only a few tomatoes left on the market, everyone would want to buy them, and the price would soar. In the crypto world, this is called supply limitation. The fewer coins there are, the higher the price, if demand remains high. Now let's talk about how to make money. There are several main ways, and each of them is a game of risk. Let's start with the most popular one. The first method, trading. It's like playing on the stock exchange. You buy cryptocurrency when its price is low and sell it when it rises. It sounds simple, but in reality, it's quite a risky business. There are people who have become millionaires through trading. For example, in 2011, a student bought several Bitcoins for just a couple of dollars. A few years later, he sold them when Bitcoin was worth thousands of dollars and became fabulously wealthy. But there are also those who lost everything. In cryptocurrencies, prices can plummet sharply, within a matter of hours. For example, in 2018, many people lost millions when the market crashed after a strong rise. Trading is like riding a roller coaster. Big wins and big losses. The key is to know when to exit the game. The second method is mining. You participate in a lottery. Every time your computer solves a complex mathematical problem, you receive a reward in the form of new cryptocurrency. It's like finding gold underground. The more powerful your computer, the greater your chances of finding a gold vein. Previously, mining was accessible to anyone with a regular computer. But now, to earn from it, powerful computers, so-called farms, are needed that operate around the clock. Plus, you consume a huge amount of electricity, which makes this method increasingly unprofitable for beginners. Moreover, in some countries, mining has been banned or restricted because it consumes too much energy. But there are people who still make millions from it. The third method is to hold cryptocurrency and wait. It's like investing in gold or real estate. You buy cryptocurrency when it's cheap and wait for its price to rise. This method requires patience, but it is less risky than trading. For example, those who bought Bitcoin in 2010 and just held it saw its price increase hundreds of times over the years. This approach is called the HODL strategy, which means to hold and not sell despite price fluctuations. Another way is decentralized finance or DeFi. Imagine a bank that operates without employees and offices. You can deposit your cryptocurrency on such platforms and earn interest for its use, just like in a regular bank. This is called staking. The platform lends your currency to other participants of the platform or uses it for its own purposes. In return, it pays you a reward. This is similar to a bank deposit. The more coins you have, the more you can earn in interest. But, like in any bank, there are always risks. it is important to remember that even the most reliable method can be risky. In the world of cryptocurrencies, high profits always go hand in hand with significant risks. Never invest more than you can afford to lose. Cryptocurrencies are an exciting but unpredictable world.